Every day when a news report gives a summary of the stock market, they talk about what is happening with three indexes, the Dow, the S&P 500, and the NASDAQ Composite. A review of these three indexes is considered to be a quick recap of the markets for the day. Obviously, these are important benchmarks, but do you know what they actually mean? In this video, I'll explain everything you need to know. Hi, I'm Dave Van Knapp, back again. Before I get going in this video, please do us a favor and help us fund these videos by clicking the thumb up button if you appreciate this content, subscribing to our channel, which I'm happy to say is up now to 70,000 subscribers, so thanks a lot, guys, and ring the bell to get notifications of new videos when we post them, and also to find out if you get a reply to a comment that you make underneath the video. This display is an overview of what stock indexes are. Number one, a stock index is a collection of stock names that follow a unifying theme. They vary widely, they being the indexes, vary widely in size, from indexes that cover just a few stocks to other indexes that cover thousands of stocks. Number two, and this is important, stock indexes are theoretical. They exist only on paper, they do not own assets, and you can't buy an index. Number three, ETFs are usually based on an index. In fact, many indexes are created from a marketing point of view so that an ETF can be designed and sold based on the index. And that's how you buy an index. You don't buy the index itself, you buy an ETF based on it. That way, the ETF can bill itself, and they all do this, it can bill itself as passive indexing in the sense that you buy the ETF and you own the ETF's portfolio. The word passive implies that not much happens in it, but in fact, because of how the index is constructed and rules that are embedded in the index, an ETF can be moving money around quite a bit, buying and selling and trimming and adding new stocks, rebalancing itself. But in the marketing literature for the ETF based on it, they'll say we passively attempt to follow after fees and expenses the results of the index, and they'll name the index. Item number four, the themes on which an index's portfolio is created can be almost endless. There are, in fact, more indexes, more stock indexes than there are stock. Common themes include what I've listed here. A theme based around a market, i.e., all the stocks sold in a particular market. Sectors, do you want to own every stock in the communications sector? There's an ETF for that. Stock sizes, small stocks, medium stocks, large cap stocks might be the basis of an index. Pick out particular industries, pick out particular countries, and finally what are known as factors that you've probably heard of, academically identified and, quote, approved characteristics of stocks that are felt to point to better likely performance, such as value stocks, growth stocks, stocks that pay dividends. Finally, the uses of indexes are they allow any of us to track the themes around which the index is based. They serve as benchmarks, and the three we're going to talk about today, that's why I'm talking about them, is they are widely used benchmarks for the health and activities of the United States stock markets. They provide ready-made portfolios. If you buy one as an ETF, you get all the stocks in the index. The ETF has already bought them for you. And because they can hold many stocks, an ETF purchase can, based on an index, can provide you with instant diversification in your investing that you wouldn't get, or you would take a long time to achieve by buying individual stocks one at a time. Throughout this video, I'm going to use the following categories and items to talk about the indexes that we're going to talk about. Number one, who runs it, who founded it, who owns it now. Number two, how old is it? Some of these go way back. Some have been invented very recently, some indexes at large, but the three we're going to talk about have long histories. How broad or narrow is it? What is the core category? What is the core theme around which the index is based? And are there prominent spin-offs and variations from that theme? How many stocks are in the index? And who decides what stocks those are? How often and in what way is the index adjusted? We will find that many are updated or rebalanced quarterly. How are the stocks weighted? This is an important subject and it'll be the next main topic in this video. We have processes known as cap weighting, price weighting, and variations of other kinds that we'll discuss. You need to know them. The style box refers to Morningstar's style box, which is a widely used way to investigate what's in an ETF or in a portfolio. And I'll show you the style box for each of the big three indexes that we're going to talk about. And finally, for those of you that might be interested in buying the indexes we're going to talk about, I'll talk about the most prominent ETFs that track these indexes. Let's talk about index weighting. Weighting refers to how the stocks in an index are proportioned in relation to each other. This is an important topic. The larger the weight of the company in an index, the more impact each price movement in each stock has on the index. This display shows the common methods of weighting stocks in index. They are called cap or capitalization weighting, price weighting, and equal weighting. In the first line item, the basic idea behind each one. Cap weighting means that stocks with a higher market capitalization carry more weight. The cap size of a company means the total shares that the company has out times the price per share. In other words, it means how much money is currently invested in that company by the investing public at large. Moving our way down that cap weighting column, an index that's based on capitalization weighting means it's influenced most by large cap companies, obviously. Cap weighting is the most common way of weighting indexes, and adjustments to maintain continuity in the value of the index are usually ongoing. In other words, as stocks change prices, the value of the index changes value, and you can see that watching CNBC every day. Not only are stock prices changing, but the values of the indexes they're showing are changing in real time. Many times, many thousands of times per day are most of them updated. Moving to the middle column, price weighting is a different approach. With price weighting, stocks with higher prices carry the most weight. So the index is influenced most by stocks that have the highest prices. This is a much less common way to weight the stocks in an index, and frankly, I wouldn't be talking about it at all because it's so uncommon, except that one of the big three indexes uses price weighting. With price weighting, since it's based on the price of the stocks, if a company splits its stocks, say a company splits 2 for 1, that means it doubles the number of shares, and each one now is worth half the amount of dollars it was before the split. It didn't really change the value of the company, but it changed the price of the stock. An index that uses price weighting has to adjust for that in order to keep continuity in the index. And in the final column, equal weighting, indexes based on equal weighting, neither price nor cap influences the weight of the stock in the index. Every company, theoretically, right after it's rebalanced, which is the word used, has equal influence over the value of the index. Many cap-weighted indexes, and we will see 2 of them anyway in this video, have equal weight cousins that are available for you to buy as ETFs. And the rebalancing to readjust the cap sizes to equal weight in most indexes takes place quarterly. Equal weighted indexes are sometimes popular with investors who like the collection of stocks but want all of them to have equal influence on the investment. So as a few stocks in an index may run away with the index because they are very successful and their price keeps going up, the equal weight version of that index will not have that outsized influence on the top few largest stocks in the index. Now let's look at the indexes in the same order that they were shown on that CNBC screenshot at the beginning of the video. The granddaddy of all indexes is the Dow Industrials Index. It's also known as the Dow Jones Industrial Average. Sometimes it's called the Dow 30, or by its initials, DJI for Dow Jones Industrial, or DJIA for Dow Jones Industrial Average. They all mean the same thing. The Dow is a stock index that tracks 30 large, publicly owned blue chip companies. Just to let you know, blue chip is a very loose phrase. It does not have an official definition, but generally it's used to refer to companies that are large, widely recognized, well established, and very financially sound. Here are the Dow 30 companies, and you can see that they are all companies of the kind that I just described. However, because the Dow only holds 30 stocks, it excludes some huge successful blue chip companies. For example, Alphabet, Google, Amazon, and Berkshire Hathaway, just to name a few, are clearly blue chip companies, but they are not in the Dow 30. Okay, here's the quick rundown on the Dow, the DJIA. It's run by S&P Dow Jones Indices, which is a unit of S&P, which is Standard & Poor's Global, and this unit, S&P Dow Jones Indices, is the world's largest source of stock index. The Dow index itself dates all the way back to 1896. It began with a simple average of the prices of 12 stocks. It now has 30 and has been at 30 for many decades. The Dow is broad, meaning it covers most or all economic sectors, which is a feat in itself considering it only holds 30 stocks. There are no transportation or utility stocks in the Dow. Those have their separate Dow indexes. In fact, the Dow Transportation Index is actually a little older than the Dow Jones Industrial Average. And the Dow is used as a gauge for the overall performance of stocks in the United States. The Dow's had 30 stocks since 1928. They're selected by a committee representing S&P Dow Jones indices and representatives of the Wall Street Journal. The holdings in the Dow have been changed about 60 times since it started in 1896. The oldest stock in it right now, i.e. the stock that's been in the Dow the longest, is Procter & Gamble. It's been there since 1932, and 3 stocks were just added to replace other stocks at the end of 2020: Amgen, Honeywell, and Salesforce.com. The Dow is the price-weighted index in this group of the 3 biggies, and that's why I talked about price weighting before, because the Dow is the outlier here. It weights stocks by price. Here's the Morningstar style map for the Dow 30. The style map, if you're not familiar with it, is a creation of Morningstar to give a quick overview, a snapshot look at the stocks that are in an ETF. And in this case, I chose the ETF that represents the Dow, so it's the same breakdown. The numbers in the boxes are percentage weights of how much of the index is contained in that kind of style box. And the style boxes are divided up and down by size: large stocks at the top, medium-sized stocks or mid-cap stocks in the middle, and small-cap stocks at the bottom. And across the top by what Morningstar calls a style, meaning do they invest in value stocks at the left side, growth stocks at the right side, or some sort of blend in the middle. The reason I'm showing you this is to illustrate a couple of things. The entire weight of the Dow, its 30 stocks, is all in large and mega cap size stocks. They're all in the top row, and medium and small all have zeros in those boxes. And you can see that it's kind of evenly spread among what might be called value stocks, what might be called growth stocks, and stocks that are blends, combinations of those two styles. If anything, I guess you could say it has the Dow has a slight value tilt here, a little more weight on that side than on the growth side, but it's not super significant. This display shows the most prominent ETFs based on the Dow, and there are only a couple of them because of the Dow's price weighting, which is a weird, goofy way to weight the stocks in an index. Not many people are attracted to it as an investment. The largest and perhaps the only ETF that tracks the Dow itself as the index is constructed is DIA, sometimes called Diamonds or Diamond ETF. It was introduced by State Street Global Advisors in 1998, and in all that time it's only attracted $31 billion. That sounds like a lot of money right now, but when you see how much say S&P and NASDAQ ETFs have attracted, you'll see that this is pretty small in comparison. And for an ETF that follows a simple list of stocks, as DIA does, its expense ratio of 0.16% is actually pretty high, too high these days, in my opinion. The second ETF I want to call to your attention is called eDow, which is an equal weighted version of the Dow index. We talked about equal weighting before. That was just introduced in 2017, and it's attracted very little money. It's just $141 million, not billion, $141 million so far, and it has an absurd expense ratio of 0.5%. Okay, let's move along to the Standard & Poor's 500, the S&P 500, which is the most prominent index for tracking the health and activities of the United States stock market. It's also run by S&P Dow Jones Indices, a unit of S&P Global. It dates back to 1957. 1957 is the first year that this index was moved up to contain 500 stocks, and it's stayed with that number of stocks ever since. Predecessors of the S&P 500 date back to 1923, and they had fewer stocks, and I think the very first iteration of what we now know as the S&P 500 had about 250 stocks in it. It's broad, it covers all economic sectors, and it mostly contains large cap stocks, which we will see when we see the Morningstar style box in a moment. How many stocks is 500? Plus or minus, because stocks are splitting, companies are being acquired. The Dow sometimes has a couple extra stocks in it, and those need to be corrected. It doesn't do it immediately when those things happen, but for the most part, obviously from its name, it's a 500 stock index selected by a committee, and they are meant to be representative of the industries that comprise the United States economy. Moving down the display, the stocks are changed every so often. There's no set schedule for the committee to make changes to the S&P 500. There have been 3 changes so far in 2022, and the S&P 500 uses the much more popular and representative cap weighting method of weighting its stocks. Okay, here's the Morningstar style map for the S&P 500, and you can see there's a little more spread here than there was in the Dow. We do see some medium cap stocks, not many, but a few. But mostly this is a large and mega cap stock index. Sometimes people say it's the 500 largest companies in the United States. That is not precisely true, but it's more or less true. And you can see a bit of a tilt towards growth in the upper line where all the stocks reside. Growth represents twice as much weight in the index as an investing style or factor than value does. This will be a continuation of what I've been saying, so the display will still be up. Despite the fact that most of the stocks in the S&P 500 are considered large cap under the Morningstar nomenclature, there is in fact a huge spread in values between the largest and smallest stocks in the S&P 500. The largest stock is more than 200 times the cap size of the smallest stock in the index. As a result of that kind of spread, and because of the weighting, the S&P 500's performance, its value as it changes throughout the day, is far and away most affected by the largest stocks in the index. The top 20 or 30 account for way over half the value of the entire S&P 500 index at any given time. This display shows the ETFs that track the S&P 500 that I want to bring to your attention. The biggest ETF that covers the S&P 500 is called SPY, S-P-Y. It was introduced by State Street in 1993, and it was in fact the first ETF ever offered to investors. It has accumulated $394 billion, so you can make that comparison to the comparatively small amount of money that the Dow has attracted in ETF form. And there are several ETFs that follow the S&P 500. So we not only have the $394 billion in SPY, the next one down is BlackRock's IVV that follows the same index in the same way. It's attracted, since 2000, being introduced in 2000, it's attracted $321 billion. The next one down is Vanguard's version of the same index. It was just introduced in 2010, but it's already attracted $280 billion. So you can see the pattern here. There are others that I don't have up because they are smaller, but just those 3 alone is almost $1 trillion worth of money invested in the S&P 500 through these 3 ETFs. Just notice the expense ratio. SPY has what would be considered a low expense ratio at 0.09%, but the similar indexes from ETFs from BlackRock and Vanguard have even lower expense ratios, practically negligible at 0.03%. The next one down in this table is RSP. That is the largest equal weighted version of the S&P 500. It's brought to us by Invesco. It was introduced in 2003, and it has $25 billion invested in it and a semi-reasonable expense ratio of 0.2%. And the last ETF I want to bring to your attention is SPLG. That's from State Street Global Advisors, which is the same company that brought us SPY, the very first S&P 500 ETF. And as near as I can tell from reading the literature, SPLG tracks the S&P 500 in the exact same way that SPY does. The only difference is it has a much lower expense ratio that makes it competitive with IVV and VOO at 0.03% expense ratio, and I suspect that that's why State Street introduced it. But they didn't reduce the expense ratio on SPY, the biggest one here, because they have so much assets under management. And believe me, the difference between a 0.03% expense ratio and a 0.09% expense ratio ends up meaning millions and tens of millions and more dollars in fees. State Street collects from SPY than it collects from SPLG. To wrap up this part of the discussion of SPY, just a couple of interesting facts for you. As of the end of 2020, more than $13 trillion is indexed or benchmarked to the S&P 500. And as you can tell from numbers like that and from how much money these ETFs have attracted, the S&P 500 is far and away the preferred index for someone who wants to invest in the market. I should also add that there are scores of funds and ETFs that I'm not going to attempt to present to you here that are tied to the S&P 500, and they slice and dice it in various ways, by sector, by leverage. There are things called bull versions and bear versions, 2x bull and 3x bull, 2x bear and 3x bear, and so on. I won't begin to try and get into those. They are designed for specialty uses. They have much less money invested in them, but they do exist. The S&P 500 is an industry all in itself, really. The number of indexes and ETFs and mutual funds and so on that have been created from what began as a simple tracking index for the U.S. stock market. Okay, the last index in the big three that we're going to talk about in this video is the NASDAQ, or the NASDAQ Composite Index. It's run by NASDAQ itself, which is the name of a stock market. It dates back to 1971. It holds thousands of stocks, more than 3,000, so it is very broad in terms of coverage across sectors and so on. But the NASDAQ, as you probably know, is dominated by three kinds of companies: technology companies, communication companies, and consumer discretionary companies. That last one may take you by surprise, but I'll explain it simply by saying Apple is classified as a consumer discretionary company, and so is Amazon. And those are two of the biggest components in the NASDAQ. And so they themselves, along with similar companies that sell things to people based on technology, it's really an extension of technology, the way most people think about it. Because it's cap-weighted, large cap companies, the NASDAQ's value, and they tend to be growth companies, as we'll see in the style map in a second. Where do the stocks come from? They come from the NASDAQ exchange. The NASDAQ exchange, which started as almost a curiosity several decades ago, was the first exchange to have electronic trading rather than people yelling at each other on a trading floor and exchanging slips of paper. The NASDAQ has now grown to where it's the second largest stock market in the United States and maybe in the world, second only to the New York Stock Exchange in size. The NASDAQ, with its tech background and tech origins, keeps up with technology. So index constituents in the NASDAQ can be and are changed daily. One day after a new company joins NASDAQ and has a closing price for the end of its first day, the next day it'll be in the index. The bottom line in this table I want to draw your attention to, it's called related index. There is a related index called the NASDAQ 100, which tracks the largest 100 non-financial companies traded on the NASDAQ stock market, and we will see the importance of that. Some people think of the NASDAQ 100 when they think of NASDAQ, but in fact on that CNBC screenshot, what they were showing you the value of was not the value of the NASDAQ 100, the compact version of NASDAQ. It was the full NASDAQ Composite Index. And that's the way I believe everybody does it. Okay, here's the style map for the for the NASDAQ Composite Index. And here you can see several things. Number one, we have numbers non-zero numbers in every box, showing the breadth of the companies that are traded on the NASDAQ index. Many of them are small startups. This is their first public trading opportunity. And those are the small cap stocks that show up in small percentages, but they're still there at the bottom of the style box. There's a smattering of mid-cap stocks, but again, this index is dominated by large cap stocks across the top row. And you can also see the tilt towards growth. This is a go-go index. Well, everybody thinks of the NASDAQ as growth-oriented and with a lot of stuff going on, and that is in fact the case. 59% of the weight of the whole NASDAQ composite index is in the large cap growth category, according to Morningstar's style box. Okay, here's another style box. I just want to show you guys this because it is the style box for the NASDAQ 100, that compact version of the NASDAQ composite that I talked to you about. And here we see even a higher tilt towards large cap growth companies. This index is totally dominated by large cap growth companies. 65% of its weight is in that element of the style box. All but 5% of the weight of the whole index is in large cap stock. In this display, I want to show you a comparison that many people are probably interested in. This compares the top 10 holdings in the S&P 500 on the left and the NASDAQ composite, the full NASDAQ, on the right. The reason I'm showing it to you is the yellow highlights. Of the top 10 companies in each index, 8 of them are the same company. They're not all weighted the same. They don't all occupy the same exact place in the top 10, but they are all there. As we all know, the NASDAQ technology companies have just taken off in the last 10-15 years and taken off a lot since COVID in 2020. So the NASDAQ has gone up like crazy. The S&P 500 until recently for both indexes has gone up like crazy. The main reason is that both of the indexes are dominated by the same stocks. In the S&P 500's case, up at the top, 29% of the value of the S&P 500 is determined by its top 10 companies. The other 490 companies account for the remainder. And in the NASDAQ itself, the composite index, the top 10 companies account for 48% of the performance of the whole index. Okay, on this slide, I want to draw your attention to 3 prominent indexes that are involved with the NASDAQ. The first one is, the ticker symbol is 1Q, ONEQ. It's Fidelity's NASDAQ Tracking Index. It was introduced in 2003. It's only attracted $4 billion in investment dollars. It has a high expense ratio as these things go at 0.21, and it holds about 1,200 stocks. We said that the composite holds 3,000, so clearly they're using a sampling method to try and replicate the performance of the entire index by focusing on a sample of its stocks, which would be the largest ones for the most part. The middle index is one, ETF is one that you've probably heard of, QQQ, or the Qs as it's sometimes called. That comes from the company called Invesco. It was introduced in 1999, so the mini version of the NASDAQ was introduced before the large version of the NASDAQ composite. And look at the amount of money it's attracted, $191 billion. QQQ is a very common investment across investors. It has a similar expense ratio at 0.20, and it holds about 100 stocks because it's tracking the NASDAQ 100 index. And the final one is QQQM, also from Invesco, just introduced in 2020. This is sort of the equal weight version of the NASDAQ. It's actually, they use, you can see in the lower right, it apportions its value by a hybrid of market cap and equal weighting. I'm not sure of the exact proportion, but it's the closest thing I was able to find to an equal weight version of NASDAQ, if you're interested in that. And it has a fairly reasonable expense ratio of 0.15%. Okay, we're at the end of the video. We're almost at the end of the video. As with all the lesson videos, I want to finish with a few key takeaways as I see them from the content of this video. Key takeaway number 1, a stock index is a collection of stock names that represent a theme of one kind or another. Takeaway number 2, common themes that you see in stock indexes include markets, countries, economic sectors, the sizes of stocks, and what are known as investing factors that are sometimes singled out as the reason to form a portfolio of stocks around that particular factor. Takeaway number 3, The big three stock indexes in the United States are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. Takeaway number 4, indexes are theoretical. They don't actually own the stocks in the index, and you cannot buy an index. Takeaway number 5, you can, however, buy funds such as ETFs, exchange-traded funds, that do replicate the indexes by purchasing and owning the stocks in them. And when you do that, you are buying an entire portfolio all at once for the price of a share of the ETF. Takeaway number 6, such ETF's performance matches the index's portfolio minus the fees and expenses that are involved in running the ETF. And finally, for takeaway number 7, I have this table that compares the big three indexes that we've been talking about. So the big three are the Dow, the S&P 500, and the NASDAQ, and I have compared them by the line items down the left side of this table, the number of stocks, the market area covered, how they're weighted, which we saw how important that is, the largest ETF you can buy to replicate the index, and how much investment money each of those three ETFs have attracted. And with that, we are at the end of the video. Thank you for watching, those of you who are still with me. Goodbye, everybody. I will see you next time.